Hello, you're welcome again to my channel. My name is Oya Benjamin. In today's video, we're going to be looking at swing trading and strategies that are commonly used in swing trading. Swing trading is a type of trading strategy where traders enter a trade and hold a position for a short period of time, like days or week, maximum 2 weeks. This is a type of trading where traders concentrate on the rising and the falling of the market. Now, the volatility of the market or the swing of the market is where they concentrate. Okay, what a swing trader does, he trades one swing per time. Now, from point A here to point B here is a swing. Now, from point B to point C is a swing. Then from point C to point D is a swing, and so on and so forth. What he does is to trade a swing per time. Okay, in swing trading, a lot of strategies are involved in making their entering and exit decision. So in this video, we are going to be looking at those strategies that swing traders use in making their entering and their exit decision. We have 8 types of swing trading strategies. Number 1, we have the intraday strategy. Number 2, we have the bounce strategy. Number 3, we have the breakout strategy. Number 4, we have the continuation pattern strategy. Now, under the continuation pattern strategy, we have the flags and we have the triangle. Number 5, we have the moving average crossover strategies. Number 6, we have the pullback strategy. Number 7, we have trading the range strategy. And number 8, the last, we have indicator crossover strategies. Now, these are 8 different strategies that swing traders uses in making their entering and exit decision. So in this video, we're going to be looking at how to apply them while trading. Number 1, the intraday trading strategy. Just like the name applies, intraday, within the day. This strategy involves comparing different time frames for a better market structure before an entry decision is being made. In intra-trading strategy, the higher time frame gives you the direction of the market, and the lower time frame gives you the full structure that you need to fix your market, fix everything that is required within the market. Now let's go to the chart and see what intraday strategy is all about, how to apply them in our trading. Now, if you look at the chart here, you will discover that we are under 1 hour time frame. And under this 1 hour time frame, there's a major breakout. For those of you that don't understand how to trade breakout, what breakout is all about, there is one of my previous video where I treated breakout, everything that you need to know about breakout. So I urge you, go and watch the video and you will understand more better how to identify and trade a breakout. Now, if you look at here, a major breakout occurred here under the 1 hour with the confirmation. Are we there? Now, you notice that in the 1 hour time frame, it has given us the direction. Okay, when you compare it to the 30 minutes, it gives you what? A structure, a long space to enter a trade, put in your stop loss, put in your take profit as you allow the trade to run. Now, let's go to the next one, the bounce strategy. In this trading strategy, the candlestick hits the support or the resistance line and is being rejected. Okay, now once it is rejected, what happens? It retraces back to the opposite direction of the current trade. Now, let's look at the psychology behind this before we go to the chart. This is the support line. This is the market, up, down, and the candlestick here or the price here is being rejected. At this point of rejection, the price trend moves up again in an opposite direction to the previous price movement. It could be on the support line, it could still be on the resistance line. Now, this is the resistance line. Now, this is it here. It bounce here, is rejected here. Okay, it bounce here, rejected here, rejected here. Now, rejected here. Are you there? Now, once it's rejected, once it hits the support or the resistance line and it's rejected, it retraces back in the opposite direction. Now, let's go to the chart and look at what bounce strategy is all about. Look at this market. Now, the market moves here and hits the resistance line, being rejected here. What happens? It retraces back in the opposite direction. Now, hits the support line here, rejected here. Now, traces back, okay, hit the resistance line, rejected here, traces back, hits the support line, rejected again, and traces back. Now, what traders does, they wait for it. Now, knowing fully well that it has been rejected here, they know that the next thing is to go down. Now, what they do, they enter their trade, their sell trade here, and take their profit here. Once the market hits the support line again, they close the sell order and initiate their buy, because they know that the price, once it hits the support level, will be rejected, and the next thing is retracing back in the opposite direction. Now let's go to the next strategy, the breakout strategy. Now this occurs when a candlestick crosses through the support or the resistance level. It could be a trend pattern forming resistance and support level, and it could be crossing through the moving average. Once a candlestick crosses through the moving average, a breakout has occurred. Let's look at how it occurs in the chart. Now this is it here. You will notice here, now this is the support line and this is the resistance line. Okay, now similar to the bounce strategy. Now once it hits the support line, the price is rejected. It moves up and it continues so on, keep moving, and all of a sudden a candle breaks through the support level. Now this is the first confirmation. The second confirmation, a trader enters the market here and takes his profit. Now I normally advise, when you are trading a breakout strategy, always observe 2 confirmations before entering a trade. If there will be a pullback strategy, the 2 confirmation is enough to tell you that there will be a pullback strategy. But after the 2 confirmation and there is no signal for pullback strategy, enter your market and take your profit. Now let's go to the next one, the continuous pattern strategy. Now under the continuous pattern, just like I said, we have 2 of them. We have the flags and the triangle. Okay, a continuous pattern occurs when a temporal corrective wave connects back to the trend or impulsive wave. Now this is it here. An impulsive wave move. Okay, now all of a sudden a corrective wave, impulsive wave, corrective wave. Now a continuous strategy occurs when the correctional wave reconnects back to the impulsive wave. Now a flag pattern is formed when the correction wave, okay, breaks a continuous trend in a direction that is opposite to the trend. For example, now the market has been in an uptrend, moving in an uptrend, and all of a sudden there is an opposite reversal in the price movement. Okay, and after the opposite, it connects back again and continue the moving, breaks again, connects back again, breaks again, connect back again. Now the corrective wave here connecting back again to the impulsive wave is called flag. Okay, now let's look at the flag. If you notice very well, you discover that this market has been in an uptrend, and all of a sudden the direction of the trend changed in the opposite direction. Now this downtrend that is formed is called the corrective wave, and this former trend that is the trend of the market is called the impulsive wave. So whenever the correctional wave or corrective wave reconnects back to the impulsive wave, a continuous pattern is formed. Another way to know when a flag is formed. Okay, now if you look at the previous direction, the trend was forming a higher lows, a higher lows, a higher lows, higher highs, higher highs, and all of a sudden there is a change in price trend. Now instead of it to continue with the higher highs, now it started a lower high, a lower high. Okay, now it started with a lower low, a lower low. Now instead of the higher high, the higher low, there is a sharp change to a lower high, a lower low. Once it reconnects from this lower high to higher high, higher high, higher high. Once there is a reconnection, a flag is formed. Now when is a triangle formed? A triangle is formed when a correctional wave breaks the continuous trend in a direction that is consolidating to the trend or the impulsive wave. Now let's look at it here. Now this is an uptrend, and all of a sudden you see a consolidation trend. Then it continues with uptrend again, consolidation trend, uptrend again. This consolidation here is the corrective wave. When the corrective wave that is in the consolidation trend reconnects back again to the impulsive wave is called the triangle pattern. Okay, now let's go to the chart and let's see how they form. Now look at this chart here. Look at this chart here. You discover that this chart is on a downtrend. How do I know it's on a downtrend? Now I have a lower high, lower highs, lower highs, lower highs, lower low, lower low, and all of a sudden there is a change. From lower low now, it enters the consolidation. Look at it now. You can see that from this low to this low on the same point, on the same support level, on the same support level, on the same support level. Instead of continuing with the pattern of the lower lows, okay, the trend enters into a consolidation, forming a support level at the base. Okay, now once such a thing occurs, a triangle is formed. Now let's go to the next pattern. Now we have the moving average crossover strategy. Now this involves when multiple moving averages crosses each other, giving you an entering and exit decision. Okay, now once there is a crossover of the moving average, it is a signal either to enter or to exit a trade. Now let's look at the chart and see how to make the best entry and exit decision using the moving average crossover strategy. Now if you look at the chart here, this is a perfect chart. Now the blue line here is the 50 moving average, and the black line here is what? The 200 moving average. Now look at it here. Immediately the 50 moving average crosses above the 200 moving average. What happened? The price trend changed to a bullish position. Now you see the 50 moving average crosses over the 200 in a downward position. So it's telling you that from henceforth that the sell order will be the best decision. Now let's look at the next strategy, the pullback strategy. This occurs when the market pulls back after a breakout is tested, okay, turning the resistance level into a support level and vice versa. Now let's look at it in the chart. If you look at this trend, once it hits the moving average, the price was rejected here, okay. Now it retraces back, came down again, the price was rejected here, it moved up, okay, came down again. Now instead of being rejected to retrace back, what happened? It broke through. After the breakout, now the market retraces back to test the breakout. Now on the testing period, what happens? The support line is turned to become resistance. After the retesting, the new trend will be established and the market will follow it. So I do advise traders, if you are trading the breakout strategy, always wait for 2 or 3 confirmation to know if a pullback strategy will occur, okay? Then if there is no pullback strategy, continue your trend. Now let's go to the next strategy, trading the range or the channel strategy. Now this strategy involves trading in line with the trend movement, observing the support and the resistance line. Now let's look at it in the chart. The market was rejected here, okay? Now as it moves up, you put your buy order. Coming here again was rejected, you put your sell order. Being rejected here, you put your sell here, okay? Your buy, your sell, knowing fully well that once it gets to the support line, it will be rejected, it will bounce back. Once it gets to the resistance line, it will be rejected, it bounce back. So you are following the trend. Now that is called trading the range or channel pattern. Now let's go to the next one. The indicator crossover strategy. This involves making an entry or exit decision using the crossover positions of indicators. Indicators like stochastic, Bollinger Bands, MACD, and the rest of them, okay? Now, depending on the one, the RSI, depending on the one that you find comfortable using. Now, let's look at it and see how it goes. Look at it here. Now, using the stochastic, you have the K line and the D line. Once the K line crosses over the D line in a downward position, what do? I put a sell order. Immediately it crosses. Now what happens? The price trend changed to a downward movement. Now look at it here again. The K line crossing the D line to the upward movement. Now because the K line crossed the D line to the upward movement, there was what? An upward reversal in price pattern. On this note, we have come to the end of this class. I believe that you have learned one or two things and you have learned the best strategy to use in your trading. But please, before you go, don't forget to hit the subscription button, the notification bell, like this video so that as we post subsequent videos like this, you'll be the first to be notified. Bye.